Options variables. Options contracts are composed of a few variables, and it's very crucial that option traders be aware of these variables so they can make an informed decision about when to trade an option. Stock price, strike price, DTE, on other words, days to expiration, option premium, and option multiplier. Very crucial, especially for those of one that multiplied by 100. Intrinsic versus extrinsic value, aka time value, bid and ask spreads, and option exercise. When an investor trade options, the biggest driver of the outcome of the trade is the price movement of the underlying. Co-buyers of stock options need the underlying stock price to rise, whereas co-sellers need the stock price to fall or at least trade sideways below the strike price sold. Put buyers of stock options need the stock price to drop below the strike price, whereas put sellers need the stock price to trade above the put or at least trade sideways, but do not trade below the current strike price. A strike price is the set price on which a derivative contract, or in other words, option contract, can be bought or sold at a particular date on or before the expiration date. The strike price can be viewed as a set price where we can go long or short on a particular stock. And depending on the type of options we are trading, there's going to be different strike price and different expiration. More on expiration in the next slides. And the different products might offer also different strike price. And normally, higher price products might offer $5, $10, $20 increments in the strike price. But in lower price products, we might see strike price within $1 difference. As you can see in this picture, using the ticker symbol SPY, which is the ETF that tracks the performance of the S&P 500, we can see that the strike price highlight in yellow has a difference of $1. And all the strike price highlight in yellow are some of the strike price for the 37 DTE in the white box. Now, let's jump to my TastyWorks platform, which I'm going to show you guys in real life the strike price of the SPY, in this case here, as you guys can see, which is the ETFs that track the performance of the S&P 500. If we open here, for example, let's look on this column here, which have all our DTEs. Remember, these are the DTEs, guys, for this product. So in this case here, what we're going to do is we're going to open here a 49 DTE. If we press here and open the chain, you guys going to see that we have the 49 DTE. These are the strike price for this expiration date, okay? And of course, this on 15th of November 2024. And this is our deltas, this is the ask and the bid. And of course, we have the mid price here, which is the difference between these two numbers here, divide by 2. So in this case, you guys can see we have 571, 570, 69, 68. It's all go by the increment and decrement by $1. Now, if we open, for example, the SPX, which it is the index itself, if we see, for example, the expiration date of $47, if we open the option chain, as you guys can see that now the increment goes by $5, and sometimes it start to drop or increase by $10. So the bigger the product might be, the bigger the strike price you might get. But in both cases, both the SPX and the SPY has plenty, guys, plenty of open interest, which you're gonna learn later on during this course. Now, back to the slides. The next option variable that we're going to study, it is the DTE, okay? DTE, guys, is just the short term for days to expiration. So every time when you're trading or you're watching a video on YouTube or reading a book, every time you hear the word or if you see the word DTE when it comes to options, it just stands for days to expiration, okay? And option DTE might vary based on the derivative being traded. Standard expiration cycles cease trading after the market close on the third Friday of each month. But many underlines have also weekly options that expires every Friday. Some underlying assets even have non-standard expiration, such as Wednesdays after the close or on Friday morning. It's very important for us to know when an option will expire to avoid unwanted assignments. More on assignments later on during the course. Using the ticker symbol here, SPY, again, the ETF that tracks the performance of the S&P 500, we can see that all the monthly option contract expiration highlight in red this time here, which are these rectangles here. The highlight column in white illustrates the days left in the option contract until the option expire. So in this case here, 9 days. This one here, let me see if I can clean here. This one, 37. This one, 72, 100, 128, and so on. And the other rows not highlighted between the red box show the weekly and weekdays option contracts. As you guys can see, have 0 days, 2 days, 5 days, 7 days. In other words, this is the weekly expiration dates. Using the ticker symbol LMT, Lockheed Martin Corporation, we see all the monthly option contract expiration highlight in red, which are those three here. The highlight columns in white illustrate the days left in the option contract until the expiration date. In this case here, 19th of August 2022, 9 days, September 2022, 37 days. At that time that this video was recorded and this presentation was putting together, okay? The reason why I have shown another example of DTs, but this time using a stock instead of an ETF or index, is to show you that stocks normally only have weekly, monthly expiration and not weekdays like in the previous example. All these things here are weekly expiration. As you guys can see, it's pretty much the difference here of 7 days amongst all these expiration date, and sometimes they go from 1 year to another year, or 6 months or 3 months, but the closest one sometimes it is every week. Option premium. Option premium is the value of an option contract. From the perspective of option buyer, the option premium is the fee that the buyer of an option contract pays for the rights to buy or sell stocks on order securities at a preset price when the contract time limit expires. From the perspective of the option seller, the premium is the fee received in exchange for the obligation to buy or sell the designated security at designated price if the option holders exercise the right. As we did before with option style, before we carry on with the subject of option premium, we need to discuss option multiplier first. Option price or premium needs to be multiplied by the option multiplier because each option contract holds or control 100 shares of theoretical assets of the underlying trade. Therefore, the price that we see in our trading platform are priced based on a single share of the underlying. So we need to multiply by 100 to get the dollar value of the option contract. Jump here now back to our TastyWorks. Let's say, for example, in this example, we're gonna pick here 49 DT. Let's say we are happy to sell here, let's say a 40 delta in this case. If we come in here, we're gonna click here on the bid, and then we're gonna get a mid price of $9.03. And as you guys can see here, this is -1. Why? Because we're selling here one option contract for $9.03. But don't forget, our maximum profit here as an option seller, it's always going to be equivalent of the premium received. And why are we getting here $903 as a max profit? Because this number here gets multiplied by 100. Every time you sell a contract, you need to multiply that by 100 to get the dollar value of the maximum premium you're going to capture for that trade. Of course, there's trade management, you might have to buy back the option and so on, but this is your maximum loss for this particular trade. Now back to our presentation. Therefore, we always need to multiply the option premium by 100 to get the dollar value of the option contract. And in this example here, instead of the option seller, we are going to buy one contract of September 16 with a strike price of 240. We are going to pay a premium. Okay, remember guys, option buyers always pay a premium in advance. We're gonna pay $1. And what is the maximum loss of option buyers? It's always equals to the maximum premium paid. So we paid $1, we multiply that by 100. So basically our maximum loss is equals to $100. Using the ticker symbol MCD, McDonald's Corporation, if we were to buy $200 strike price call option on McDonald's, it will cost us $1. So in this case, we will have to pay a total amount of $100 to have the rights to exercise the option, and in this case here, sell, because remember, we buy a put. So in this case, we can sell McDonald's shares for $240 even if it drops all the way down to $180. So basically, we are paying $1 to have the rights to sell or exercise the option at the strike price of $240 if the stock go past our strike price. But of course, if it trades sideways or it trades up, there's no reason for us to exercise this option. And that's why in this case, the maximum loss of the option buyer would be $100, as I mentioned before. Always, the maximum loss of option buyers, it's equal to the premium paid, and the maximum gain, the maximum P&L of an option seller, it also is going to be equivalent to the option premium received. Now that we have learned how option multiplier works, we can carry on with the subject of option premium. And the next thing that we need to learn when it comes to option variables, it is the subject of premium. Consists of two things: intrinsic value and extrinsic value. Extrinsic value, it's also known as time value. The intrinsic value for an option contract represents the price difference between the stock price and the strike price at the time of the valuation. Pay attention to this. Only in the money options have intrinsic value. Out of the money options, or in other words, OTM for short, have zero intrinsic value, as there is no such a thing as a negative intrinsic value. Now you must be asking yourself, what the hell is ITM or OTM? In other words, in the money or out of the money. The best and simple way to explain ITM or OTM options without getting into more details, it is using our previous example of the option variable that we have studied, which it is the stock price. Because in other words, option moneyness is a way to define the value of an option contract relating to its strike price and to the current price of the underlying asset. The more ITM an option is, the more it worths. But theoretically speaking, ATM, or in other words, at the money, it is options that define as a situation where the strike price of the option is identical to the current market price of the security. In other words, let's say, for example, our strike price, it is $100, and then at the expiration date, the stock price is also $100. It's very, very rare to happen at the expiration date. OTM, it stands for out of the money, which is defined as an option which has not yet reached its strike price. For example, we have here, let's say a chart, we sold a call option here. At the expiration date, the stock is trading below our call option. Or if we sold here a put option, the stock price, it is trading above our strike price. So this call option here and this put option here that we both sold, it is trading out of the money. ITM stands for in the money, which it is defined as an option state of moneyness. Like before, I gave an example for you guys of the put and the call option. Let's say we bought here a call option and we bought a put option here. In this case, if the expiration date, the stock price is trading above our call option, this option will be trading in the money. Or if the stock drops and trade below our long put option, this option will also be trading in the money. Remember, call buyers of stock option need the underlying stock price to rise. Call sellers need the stock price to fall or at least trade above the call price. Put buyers of stock option need the underlying stock price to drop. Put sellers need the stock price to rise or at least trade above the put option. We can see in this graph, to make things even easier for us to understand, when it comes to ITM and OTM option, how it works. Let's say, for example, you are a long call option buyer. You bought long call at 310, 320, 330, 340, and 350. What happens if the stock price is trading at $300? You'll be losing your whole premium. Why? Because the stock price, it's not above the strike price. It's very simple. But let's say, for example, you bought here the strike price of 310, 320, 330, but you bought long puts. Why you making money? Because your 300, it is below all the strike price of the long put that you bought. In this case here, for example, if you sold options at this strike price, you'll be pretty much having all your strike price expiring out of the money. Why? Because all the strike price, it is below the current $300 per share. But if you bought a long, let's say a long call option, in this case here, what's happening is you'll be making money because the $300, it is above all this strike price. So here, if you have a long call, you're making money. Here, you're losing money. Why? Because as a long buyer, you'll be losing money. The person that will be making money here, it is the call seller. Why? Because the $300 hasn't breached all this strike price. So very simple here. Let's do one by one, for example, so you guys can understand. Okay, we have our strike price here, 310, 320, okay, whatever. The stock price is at 300. So if you short a call here, you'll be making money. Why? Because 300 hasn't passed all this strike price. But let's say, for example, here, you bought here all this strike price here of 250, 260, 270, 280. And if the stock price is trading 300, you'll be making money. Why? Because your stock price, it's above all the strike price. But let's say, for example, now you bought a long put at 310, 320, 330, and 340. Why you be making money? Because the stock price is trading all the way down here at 300. So basically has breached, in other words, all the strike price. And if we have sold, for example, okay, at 250, 260, 270, and the stock's trading up here at 300, you are making money as option seller. Why? Because the stock price hasn't breached your strike price. Very, very simple, guys. So the main goal here is to pay attention to the current stock price. If the current stock price it's above the put sold, you're making money. If the stock price it is above the calls that you bought, you're making money as a long put or call option. If the stock price it is below the short call, you are making money as a call seller. If the stock price it's below the strike price of the long put, you are making money as a put buyer. So now that we know about option moneyness, or in other words, ITM, ATM, and OTM options, let's go back and see some examples of option intrinsic and extrinsic value. Let's say that the stock XYZ is currently trading at $9 per share. We buy a long call option at the strike price of $95, and for us to have the right for buying this call option, we have to pay a premium of $1. Remember that. For us to make money, we need the future stock price to be trading above our break-even, which it is the strike price plus premium, which it is our strike price plus our premium, which it is this distance here. Our strike price 95, we paid $1 for this premium. Our break-even, it is 96. Anytime the stock price breaches $96, we'll be making money on this call option. If the stock price after X days is currently valued at $100, the option has an intrinsic value of $5, which it is the current stock price of $100 minus the strike price sold at $95. And in this case, one could exercise a call option right away to receive $500, which it is 5 times 100. Remember, the option multiplier. Such an option is known as in the money. But don't forget that we have to pay $100 for it as well. In other words, we have a $905 year strike price. The stock went up to 100. So basically, our profit here, it is S note, which is the currently stock price at the moment, minus our strike price. 100 minus 95. So basically, we made here $5 in this long call option. But remember, we have to pay $1 to have the rights to exercise this option. But $1 multiplied by the multiplier, it is minus $100. So basically, in this trade here, we made a net profit of $400 for the stocks trading at $100 at the moment. However, if the stock price at X days it is trading at $80 per share, there will be no intrinsic value, and that's known as being out of the money. In other words, we have a strike price of $95, the stock dropped to whatever price, to 85. Because our strike price here, it's below, so in other words, our stock price, as note, is below our strike price, this option will be trading out of the money. And just to finish it off, the subject of option premium, these are the keynotes everyone should be keeping in mind. For any financial instrument, be a stock or an option, there is a bid price and an ask price. The bid price is the best, or in other words, the highest price someone is willing to buy the instrument for. And the ask price is the lowest price someone is willing to sell the instrument for. Makes sense if you think about it. Bid equals buy. Therefore, the buyer wants us to buy at the lowest price. And of course, ask is equals sell. Therefore, the seller wants the highest possible price to sell his asset. As a quick example, if someone were to buy the stock symbol AAPL, aka Apple, which have the following bid and ask price. We have here the bid of 169.84 and an ask of 169.85. Someone could place a limit order at the mid price of 169.845 and wait to get filled. In other words, you can get a mid price here by adding these two numbers and dividing by 2, and this will give you the mid price of Apple right now. But because this is a course on option and not on how to buy stocks, we are interested in this price, as well as we can see the yellow box, which are the respectively price of the call and the put options. In this example, the $145 strike price has a bid of 167 and an ask price of 169. If you were to buy the 145 long put at the strike price of 145, we could place a limit order to at the mid price of $1.68 and wait to get filled. The bid and ask spread is important to understand because it provides us with a way to measure the liquidity of an option contract. A wide spread means that an option is less liquid because there are typically less buyers and sellers. In other words, lower volume for the option contract. Exercising an option means executing the contract rights to buy or sell the underlying asset at the state price on or before a specified date. Remember that option holders, call and put holders has the right but not the obligation to buy or sell, or in other words, exercise the option anytime. Exercising and put options allow you to sell the underlying security at a state price within a specific time frame. Exercising a call option allows you to buy the underlying security at a state price within a specific time frame. There are many factors that we need to consider before exercising an option contract, such as what type of options do we have? Can we exercise the option? Will the cost outweigh the benefits? Are there any tax involved? Is still bullish on the stock or not anymore? Do you really want to buy or sell the underlying shares? How much time value is left on the option? Transaction cost through commission, another big thing as well. Higher margin exposure by holding the stocks. And in most cases, options can be closed rather than exercised through offsetting transaction prior to expiration. Traders are not interested in exercising an option, but rather close it for a gain by capitalizing the difference between the stock price and the stock price. In other words, sometimes the stock price minus the strike price, depending here if you are, for example, short or long, or if you bought a call or if you bought a put option. Sometimes it doesn't make much sense in exercising an option that has time value left on the option because the time value will be lost in the process. Holding the stock rather than the option can increase risks and margin levels in the brokerage account.